If you're a serious stock market investor, this is one of the most important videos that you can watch. And the reason why is because we're gonna be talking about analyzing one of the most important aspects of a company, and that is its cash flow. A company's cash flow is best described as a company's blood. And guess what? If you run out of blood, you'll die right away. So that is the last thing that you would want to happen for a company. Hi everyone, my name is Guillermo, and I've analyzed over $1 billion worth of real estate deals working at one of Canada's largest real estate investment trusts, and I'm also the CEO and founder of White Sheets. And in this video, I'm gonna share with you how it is that you can effectively analyze the cash flow of any particular company or stock that you're analyzing, giving you 13 specific metrics to look at. Not only are we gonna be talking about those 13 metrics, but also what they mean, how to use them, and how to get them automatically on your spreadsheet. Okay, so as you can see, here's a list of the 13 cash flow metrics that I recommend that you look at when you're analyzing a particular company. What I want to do is walk you through each of these metrics, show you the most important things that you need to know about each one, and I also want to show you practical examples of where it is that you can find this information in the cash flow statement and also the other financial statements, and also how it is that you can analyze it and draw meaningful conclusions from this information. So first off, we have the operating cash flow, which you can see right here. This measures the cash generated from the core business operations, and it is basically calculated as taking the net income, adding any non-cash expenses, and taking into account any changes in the working capital. So if I go back to this specific spreadsheet, I'm going to do this for Apple, and I'm going to get all of the financial statements so that you can get the data and be able to analyze what I'm about to talk to you about. If you click right here on the cash flow statement, you will see net cash provided by the operating activities. This is the operating cash flow, and you can see how this is calculated step by step. So it's basically taking the net income of the company, adding all of the different items that we talked about, and that provides you with the cash flow that the company generated just from the operating activities. This cash flow is really important because this is the real cash flow that a business can use to invest in its own operations, to give you a dividend as an investor, and to do all the different things that are going to either continue to improve the business or make the performance of that business worse off. What I recommend that you look at for this metric is a healthy growth of this metric over time, and this is something that you can do research, read the company's annual reports to see what measures the company is taking to continue to improve this measure over time. Next up, we have the working capital, and this is basically looking at the balance sheet where you take the current assets, which you can see right here, minus the current liabilities, which you can see right here, and this gives you the working capital. This number is really important because if a company runs out of working capital, that is a real issue, and the reason why is because working capital is how much money the business has to fund the operations right now. If you don't have any money, you're gonna have to go raise it, and then you could also get into financial trouble if you're not able to raise that money. Therefore, it is really important to keep an eye on this metric and ensure that the company has enough of that money to be able to continue its operations and also to continue to grow. So if we were to calculate this number for Apple right now, where we take the current assets of the company minus the current liabilities, you will see that in this case the number is negative, which is not a good sign, but in the past it's been positive and the difference has been really big. So maybe in this particular year Apple made an exception, but you really want to keep an eye on this. Next up, we have the forecast variances. This is basically the difference between what you project as a cash flow for a particular company versus the actual results. This is more advanced, and this is if you're applying something like a discounted cash flow model, which we have videos that you can check out on our channel. But this is something that you can measure yourself so that you can improve your accuracy as an analyst and make your valuation models more accurate. The next two metrics are very similar, so days of sales outstanding and days of payable outstanding. This one measures the average number of days that a company takes to collect a payment after the sale is made, and you can see how this is calculated right here. And this one is very similar, except this quantifies how long it takes for a company to pay its bills. You can find both of these metrics right here along with a whole bunch of other different metrics. So I highly recommend that you check this out as well. Then we have the current ratio. This is very similar to the working capital, except you're dividing the current assets minus the current liabilities of the business. So obviously, if you have more assets and less liabilities, that is a really good thing. So that is the kind of thing that you're looking for in this ratio. Next up, we have return on equity, and this is a very common number that you see all over the place. And this allows you to measure the profitability of a company in relationship to the ownership of the shareholders. So the formula is taking the net income and then you divide that by the shareholders' equity. The higher of a number, usually the better, because it means that the company is more efficient. It means that the company is able to make more money, more profit for the shareholders relative to what the shareholders own of that company. So if you see a number like 30, 40, 20%, like it really depends on the industry. That is a really good indicator. And obviously if it decreases over time, that is not a really good sign. As you can see for Apple, you can see the ROIC. This is the return on invested capital, and the return on equity is right here. So for Apple, this number seems to be extremely high, 196%, 150%, 87%. These numbers are really great, and this indicates that this is a really good company. Now, before I get to the other metrics, I just want to say that I'm going to share with you a way where you can get a lot of different companies, put them all in your spreadsheet, and get a whole bunch of these metrics automatically calculated for you. So if you're interested in that, you can skip to that section of the video. That being said, let's continue. So we have the free cash flow. This number is extremely critical because the free cash flow is the real money that a company has to be able to invest and continue to grow, or give that money to shareholders in the form of dividends. So for that, you basically take the cash flow from operations, or the operating cash flow that we talked about before, minus the capital expenditures. Capital expenditures is the amount of money that a company is investing in itself to continue to grow. So this number is really important, and this is something that you can usually find on the cash flow statement, or you can calculate it based on the formula that I gave you. So if you look right here, we have the operating cash flow for Apple. You can see all these different numbers, and then we have the capital expenditures again from the financial statements. So if you take this minus this gives you the free cash flow of that particular company. And as you can see for Apple, this is growing at a pretty healthy rate, and that is a great sign for investors. Next up, we have the cash flow coverage ratio, and this basically measures the ability of a company to pay its obligations, meaning its debt, the money that it owes because it took different loans. And so the way that you can calculate this is you take the cash flow from the operations and you divide it by the total debt of the company. So if you look at the balance sheet right here, you will see a total debt metric right here, which I can expand for you so you could see it. And this is the number that you would be utilizing to make this calculation. And this basically tells you, based on the cash flow, because cash flow can be used to expand the business, to provide dividends, and to pay debt, how well is the company positioned to be able to afford to pay the company's debt. It's a good ratio. Obviously, the more cash flow you have, the better a company is relative to the total debt that the company has. If the company has a lot of debt and not a lot of cash flow, that is a really important warning sign that you should not ignore and highly consider if you're looking to invest in a particular company. Next up, we have the cash conversion cycle. And this one, I'm not going to go too in depth into this particular metric because this is essentially another metric to analyze the working capital and the efficiency of a company. But you can see how the formula is calculated right here. And obviously, the higher the number, the better it is for that particular company. The next one we have is this liquidity ratio right here, which is very similar to some of the other ratios that we already talked about, especially the current ratio. And this measures is another measure for a company's ability to cover its debt with its liquid assets. So you basically take the most liquid assets of a company, which in some cases are like cash. That would be a really liquid asset because you can just use that money right away. You don't have to wait to be able to sell something that the company owns to get that money back. And then you divide it by the current liability. So this is kind of like a more conservative way of calculating the current ratio. Next up, we have the sustainable growth rate. And this is a really important number. I remember learning this in my finance class a long time ago. And this basically allows you to measure the maximum growth rate rate that a company can achieve without taking on financial leverage, otherwise known as debt or basically loans. This number is calculated by taking the return on equity and then you multiply that by 1 minus the dividend payout ratio, and this tells you what is a healthy amount that a company can grow if it doesn't want to take additional debt. This number is important because you can use this in your assumptions as kind of like that top growth rate that a company can have. So this allows you to, have better assumptions for that, and when you do like a valuation or something like that, you're gonna be able to have a more reasonable time being able to come up with the assumptions for that. Okay, so now I want to show you something really cool, really fast, and this is that you can have a list of stocks of up to 1,000 stocks. In this case, we just have like 20 companies, which is okay, but this illustrates how powerful this is. Using Y Sheets, like you can see right here, this is the add-on for Excel and Google Sheets that I was talking to you about before. You can get the list of stocks that you want, the different metrics. In this case, we have a whole bunch of the different metrics that we talked about. And what you can do is select the list of tickers that we can see right here. And then we want to get all these different metrics or parameters. So we select them, click here. And now what we could do is click on get data, and very fast, you're going to be able to automatically get all of the data right at once. You can format it. So for example, this right here, we can format it as a percentage, add more decimals if we want it as well. And you can see how right away you're able to get the data. You can apply any filters that you want and then click here to refresh the data that you want. You can also change the period of this data. So right now, all this data is for the last fiscal year. We could also make it TTM. So all I need to do is add TTM right here, click here, and this is going to automatically update. You can also get this for previous years. So for example, I could do LY -4. This is going to give you the operating cash flow from 5 years ago. So if I click here, you will see how this will update as well. And you can also get quarterly data. So for example, I could just simply do that for the working capital, click on refresh, and you will see how this will refresh as well. From here, you can perform any calculations that you like, any filters, any analysis, and this makes analyzing a company's metrics really, really powerful and allows you to find those great investment opportunities faster. Now you know how to analyze a company's cash flow like a real pro. So go ahead and use this information so that you can make some really good investment decisions for yourself and for those people that you most care about. If you've enjoyed this video, make sure to subscribe and turn on the notification zone so that way you get notified every time we release a new video like this that's going to allow you to take your investing game to the next level. I'll see you in the next one.